All right, class, this is to review adjusting and closing entries. Okay, so what you're seeing here listed on the bottom are the two adjusting entries that you need to do. First, decrease supplies and increase supplies expense. You're decreasing the supplies for the amount that you use during that fiscal period. And then you decrease insurance and increase insurance expense. You're just decreasing insurance by the amount of insurance you use during that fiscal period. And in this case, it's a 1 month fiscal period. What you're seeing here is that you had 2,500 in supplies. You now have 1,500 in supplies, meaning that you've utilized 1,000. So we're making supplies go down with a credit and making supplies expense go up with the debit, because expenses go up with debit. Same idea for prepaid insurance. You bought $2,000 in insurance, and now you have $500 in insurance left over, leaving you with an adjustment of $1,500, meaning that you need to make your prepaid insurance go down $1,500. Assets go down with credits, and then expensing it, expenses go up with debits. So insurance expense goes up with debit. This is what the debit and credits would look like for those two transactions here for adjusting entries. Supplies going down, supplies expense going up, insurance going down, insurance expense going up. Closing entries are color-coded and highlighted and listed here. There are 4 closing entries. They're all temporary accounts that are closing out. Sales expenses, income drawing, income summary and drawing are your 4 types of accounts that need to get closed out in temporary accounts. There's 4 closing entries. Each entry involves one of those. Sales close out to income summary, expenses close into income summary close into capital, and then drawing close into capital. The first one of sales, normal balance on the credit side. So to close out sales, you debit it, that amount, and transfers to income summary as a credit, which is a good number. A credit in income summary would be making capital go up. Expenses all have normal balances on the debit, so you would close them out with credits equal to the balance to zero them out. They get added up and sent as one number to income summary over on the debit side. At this point, this would be a profit. Your sales number is more than your expense number. You're heavy over on this right side, the credit side. So to close out income summary, you'll have a balance over here of 7,500. You need to journalize 7,500 here to close it out. Once it closes out, it transfers to capital as a credit. If it's a profit, you want it to make capital go up, and it goes up with a credit. The opposite is true if the expenses was more than the sales, and I'll show you that on the next little sheet. The last thing that you need to close out is drawing. Normal balance of drawing is on the debit side, so to close it out, you would want to credit it equal to the balance. So this is closing out drawing and transferring that value to capital as a debit so that capital goes down. Okay, let's see here. This is the closing entries, and they're listed here to the sides, 1, 2, 3, and 4. You can see that you close out sales with a debit to zero it out, and it transfers to income summary, making it go up with a credit. Your expenses all get zeroed out and closed out with credits, and they get sent as one number to income summary as a debit to make it go down. Income summary, if there's a profit, you close out income summary with a debit, and it transfers to capital as a credit, making it go up. If there was a loss, you close out income summary with a credit, transfer it to capital as a debit to make capital go down. And then finally, drawing closes out with a credit to zero it out, and it goes to capital as a debit to make capital go down. All right, that is the end of the review video. Have a good day.